Investment strategist at Citi Private Bank joins us from Hong Kong. John, great to have you back on ET Now. Thank you for joining us. John, does the hawkish Fed China risk-led correction makes Asian equities an attractive investment destination? And do you see value emerging in any of the key Asian markets after the recent correction?
Well, I think there are two questions to ask here. Some in the market are looking at a mini crisis developing in the EM space, given the huge amounts of liquidity, particularly since 2009, that have flowed into these markets. The view is that as currencies weaken in Asia and as tapering concerns are priced in, investors, particularly those in developed markets, will start repatriating some of their liquidity and no doubt profits gained over the past 2 or 3 years. We, on the other hand, tend to think that there is certainly going to be a likely repricing of EM risk, but it's far too early to say whether that will deteriorate into an EM crisis. More likely, we think we will see some of the very low, for example, bond yields in emerging markets correct, and indeed we've already seen that, and the same for equity markets. And over the past 4 to 6 weeks, we have seen a very dramatic repricing. In other words, I think at the current time, the downside is somewhat limited. I think that we'll probably see further corrections over the illiquid summer months. There's a seasonal factor there at work as well. But we would expect to see the downside priced in by August and would anticipate actually a rally into September of this year.
Right, John, so is the risk-on trade over for now, and do you expect volatility to stay for some time?
Yes, absolutely. I think there's new news in the market. The taper is now having to be priced in. It's rather jarring. It's rather dislocating for investors. We will absolutely continue to see capital outflows from emerging markets into developed markets. That will include Asia, and particularly for those Southeast Asian markets that were much more domestic in nature, much more defensive in terms of their market makeup. We would expect to see some price corrections. But for the exporters, for the cyclicals, and I guess that is largely a function of North Asia, we would expect to see, as I say, some sort of price upswing, particularly into the September period of this year.
So, John, do you expect a lot of debate on EMs versus DMs in coming weeks?
Yes, I think that's absolutely the case, and in fact, to be fair, we're already seeing it right now. We have seen a huge amount of liquidity flowing into emerging markets pretty much since the Lehman crisis in 2009. There is a risk now that part of that is going to be repatriated, and that will clearly have an impact on emerging market risk. The earnings profile needs also to be looked at quite closely. Some of the valuation metrics, some of the profit metrics in EM continue to underperform those in developed markets. And for that reason, we in the market are generally looking at a further price correction with limited downside, but at a point that we think markets will look a lot more attractive into the third and fourth quarters of this year.
John, what about debt versus equities? What's your stand when it comes to that?
Well, we've seen an extraordinary amount of outflows from emerging market bonds since the infamous May 22nd FOMC press conference. For example, in India, we have seen $5 billion flow out of that market, and it's had a clear impact on yields. In fact, if you look at bond yields right around Asia, you can see some reasonably sharp spikes, partly on the outflows that I've mentioned, and partly also on the repricing of bonds as a consequence of the tapering. So as it stands at the moment, we're seeing bonds substantially underperform equities. I do believe, however, that there will be some catch-up. It's unlikely that EM equities are going to escape this repricing completely. And I do think, as I say, over the illiquid summer months, we will start to see some volatility, some price correction continue. But again, and I have to repeat this, with limited downside.
John, fears of fund flow slowing or reversal has basically led to Indian rupee weakening quite substantially. Do you see any merit in these fears?
Yes, the interesting story about India is that since 2009, around 88 or 90 billion dollars of foreign equities have flown into the equity market. Compare that with the bond market, which has enjoyed inflows of around 23 to 25 billion US dollars. Now, as I mentioned, at the current time, it's bonds which have been most impacted by the tapering repricing effect. 5 billion have flowed out of Indian bonds in the last few weeks. Now, as it stands at the moment, we haven't seen dramatic outflows from Indian equities. I suspect we will. It seems to me highly unlikely that one risk market will completely avoid the downdraft that has impacted bonds. So I do expect to see some further repricing downward of Indian equities as these outflows take place, as the weaker INR is factored into local investor considerations, and obviously as the higher interest rate regime at the global level is priced in.
So, John, where do you see opportunity in Indian equities, defensives or cyclicals?
Well, I suspect that the entire market will not escape the downdraft that's likely to play through over these illiquid summer months, but clearly in such an environment you would want to lean to the more defensive names as a way of better protecting your price volatility going forward.
Weak currency as well as improving developing market outlook should augur well for exporters then. Would you advise investors to pick quality stocks there?
Well, I think that we will see and continue to see some further weakness in the INR. I think the next technical level is going to be around the 62, 63 area. This obviously is a function of, I guess, some political uncertainty ahead of elections. It's an uncertainty around the weakness in its own way of the INR, capital outflows, fragile risk sentiment. So I do expect to see further currency weakness. Whether or not we buy exporters or not, I think is more a function of global growth. If we continue to see some stability, particularly in developed markets, I think that does augur well for particularly Indian exporters, because of course they have very little price competition with Japan, which clearly is affecting some of these North Asian countries, particularly Korea.
John, what about the political risk for India? Do you see any danger of this derailing the India story?
Well, it's an overlay which creates uncertainty, and certainly there is, I guess, a policy inertia which can reasonably prevent some substantive and aggressive reforms playing through. So, for example, I expect to still see the fiscal deficit weigh on investors' minds. This will lead through clearly to the scale of the current account deficit. That will inevitably have an impact on the currency. So I guess they're all interconnected, and they all will ensure that I think investors remain somewhat cautious in the coming months and indeed the coming quarters as it relates to investment, particularly from offshore into Indian equities.
What about China then? Do you expect the situation to ease out in the coming months, and will you keep an eye on PBOC steps?
Look, the entire market is keeping a very close eye on the PBOC, particularly as it relates to monetary policy. We heard, for example, some indications from the PBOC over the weekend that some possible loosening was likely, and particularly as the growth trajectory decelerates in China, further talk of loosening is inevitable. However, the PBOC would not have been able, in our view, to keep rates as high as they were without the support of the government. And to that extent, I think that it is determined to communicate quite a strong message, particularly to the smaller banks, to put their balance sheets in order, to try and unwind some of these wealth management products, which have caused so much of a concern with the PBOC in the shadow banking system. So we would expect to see a rather jarring, but I think over the medium term, positive move by the PBOC to try and adjust some of these imbalances in the shadow banking system.